Welcome to the Real Estate Forum, a podcast from the Paul Milstein Center for Real Estate at Columbia Business School. I'm your host, Raphael Sidelsky. This is your place for key insights into the evolving real estate landscape, from candid conversations with real estate thought leaders, including the esteemed faculty of the MBA Real Estate program, to cutting-edge research from the Milstein Center's Research Lab. Let's dive in. My guest for this episode is Lauren Hochfelder, Managing Director of Morgan Stanley and Head of Global Real Assets, which has over $75 billion of investable capital across private real estate, private infrastructure, and private real assets credit, including Mesa West Capital and European Secured Credit. Lauren is also a member of Morgan Stanley's Investment Management's Operating Committee and the Global Asset Allocation Committee. She joined Morgan Stanley in 2000 and has held a number of senior leadership roles during her 25-year tenure, including co-head of Morgan Stanley's Real Estate Investing, head of the Americas, deputy chief investment officer, and co-head of U.S. acquisitions. She graduated magna cum laude and with distinction from Yale University, receiving a Bachelor of Arts in Ethics, Politics, and Economics. Lauren, welcome to the show.
Thank you so much for having me. Great to be together.
How did you find your way from studying ethics, politics, and economics to real estate at Morgan Stanley in 2000? And has that interdisciplinary lens shaped your investment or leadership approach?
So I joined Morgan Stanley right out of college, so right out of Yale, and joined as an investment banking analyst, like many do. And at that time, our real estate investing business was housed within investment banking. So today we're a part of the investment management division. At that point, our business had grown out of IBD. And so I joined investment banking, but had the opportunity right away to work on investing in real estate and honestly just loved it right away. I loved the problem solving. I loved the accountability that comes with investing. I loved being forced to make judgments amidst uncertainty. I loved it all. And so I would not have predicted on graduation day that I would be here nearly 26 years later, but it has been extraordinary. To the second part of your question, how is that degree? Yes, I don't think I certainly had not learned the financial modeling in college, so it did not prepare me in that way, as many of my colleagues had been prepared. But that interdisciplinary framework has proved extraordinarily valuable, over time. I think not just the broader lens of problem solving, but investing obviously is about knowing what's going on in the world and understanding economic cycles and understanding the geopolitical landscape, all of the things that I got to study quite a bit at Yale. So I feel very fortunate for that education.
So you spent your entire career at Morgan Stanley, rising from an associate during the dot-com crash to now 25 years later leading global real assets. What are the benefits of institutional memory versus the platform hopping that is quite common in the industry?
Yes, gosh, I feel so old-fashioned to have chosen to stay at one place for my whole career. But I think it is so underrated and so extraordinary to stay at one place. For starters, my partners and I, my team and I, we have really lived through cycles together. And I think that's not only something that our investors like, that we're cycle tested as a team, but I think it's something that makes all of us so much better because you have accumulated trust over time, right? You build that trust and that judgment in each other. You start to really understand each other's risk tolerance. You can communicate more efficiently. And at the end of the day, I think you get to much better judgments by trusting each other more. Not to be clear, not because you trust each other so you defer, but because you trust each other so you're that much more willing to challenge each other's perspectives. And that is fundamentally, I think, how you get to better decisions. And also not unimportantly, I think how you develop better culture. So one of the things I love so much about what I get to do every day is the people with whom I work and the culture that, we exist in. And I think sort of that trust in each other that's developed over years and decades and different types of experiences together is so fundamental. And probably, frankly, applicable externally as well. So, having that consistency of approach and the consistent relationships, obviously, as you well know, real estate is very much a relationship business. And when I think about how we're able to so consistently um, find better opportunities or execute better on the ground, a lot of that is our external counterparties. And I think being in one place, on one team, for so long has really helped build those trusted counterparty relationships that helps us drive a lot of value. So I know it is much more in vogue to jump around these days, but I think it's really underrated the compounding benefits of being in one place for a long time. And by the way, it's really fun to get to build and rebuild together, right? We take a lot of pride in the business that we've built and rebuilt through decades.
Well, having invested through the dot-com downturn, the great financial crisis, COVID, and today's higher rate regime, are there any fundamental truths about real estate that have remained constant for you? And conversely, any legacy rules of thumb that you've had to unlearn?
In terms of the universal truths, one is just supply. It is ultimately what tends to bring most cycles to an end, at least here in the US, that has the most efficient supply side response. So, rents run, values appreciate, builders build, and it sort of, brings an end to each cycle. And so I think really thinking about how scarcity can drive rent growth and how supply barriers ultimately determine which markets will see the greatest value appreciation over time. So first is supply. Second, runway. Right? Runway really matters. Cycles are inevitable, but having the durability to withstand is ultimately, I think, what begets the best outcomes. And I think when we talk about runway, what comes to mind first is financing. So having duration on your debt. But I think it also comes in other forms. So having durable cash flow, for example, is another driver of runway, and I think that's extraordinarily important. I'd say another. When you start in real estate, I'm sure you had the same lessons right. Location, 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 and obviously location matters a tremendous amount. But actually, I think today is a bit different. I think it's dislocation, right? It's not just finding the right location. It's seeing what's changing, seeing what's being disrupted and investing accordingly. So real estate, as we know, is just sort of the infrastructure underlying our lives. It's how we live, where we work, how we shop, how we travel. It is the physical infrastructure that underlies our lives. And so when you see changes in human behavior, you want to own that infrastructure they're going to need tomorrow. And so when you look at some of the biggest movements, both positive and negative in our space over, the last 25 years, much of it has actually been not changes in interest rates, but changes in human behavior. So you look at industrial real estate, run up, which is something that we, really participated in, and the rise of e-commerce. That was just a fundamental shift in how people shop. And, we can talk about that more, but the point is, while I still subscribe to location, 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 I think dislocation, 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 even more important. In terms of the things to unlearn, look, when I started, I think when you started, institutional real estate investing was three-quarters office buildings and malls, right? I mean, if you were a real estate investor, what it meant is you bought really great, glass and steel office buildings, and you bought some fortress regional malls. That was three-quarters of institutional real estate. And today it's the opposite. So again, I think and it ties into the dislocation point, but really understanding how the drivers have shifted and not being wedded to the past. And I guess I would just add financial engineering, right? Obviously, I think there were a lot of lessons learned about excess use of debt that led, into the period of the financial crisis. I think I'm not alone in learning that lesson. I think our industry learned the lesson the hard way. And certainly you see pockets of problems, in the market today. But for the most part, I think that is a lesson that the industry has evolved on as well.
Last year, you were elevated to head of global real assets. How's the transition been from purely real estate to other asset classes as well?
It's been phenomenal. So private real estate is the business that I came out of is the largest part of real assets, but we have an extraordinary infrastructure business and two, industry leading real estate credit businesses as well, one here in the US and one in Europe. And what makes my job such a privilege is how extraordinary those teams are. It's been an incredible sort of intellectual challenge and gift to broaden my focus. But what's been most exciting is to work with great teams. And I had, these are teams that were not new to me. So our infrastructure business, I had been on their investment committees for, many, many years. So I knew the team well. I knew their portfolios. Our real estate credit businesses, obviously quite adjacent to what we had been doing on the real estate equity side. And there's so much commonality and so much shared perspective that is so mutually beneficial that, I think it also enables us to now really do more for our important clients as well, right? There are many similarities and distinctions between the different types of real assets. And so being able to face our clients and provide more holistic solutions is really exciting.
Are there any signals you take from one sector to improve your approach to others?
In investing, there are sort of knowns and unknowns, and we are really trying to invest thematically across everything we do in more structural mega trends, in long-term drivers of demand that are less linked to economic cycles. So, demographics, supply chain realignments, things that are much more structural and long-term in nature. And so I think having an understanding of those, they may be applied differently across the different spaces. You may want to lend in different, sort of place than you want to invest equity, or you may want to, certain types of real estate might indicate greater needs for power. And so our infrastructure business may play it more from a power standpoint, but it's so interconnected, endlessly.
Tell us about the Global Asset Allocation Committee and your role on it.
We, across real assets, we manage nearly $80 billion, but Morgan Stanley Investment Management overall is a $1.9 trillion business. And so MSIM, we manage capital across virtually every asset class, and we have extraordinary teams. And so being a part of the Asset Allocation Committee, but frankly, just being a part of MSIM leadership overall gives me really unique access to the greatest brains in the business when we're investing in advanced manufacturing assets in our real estate business. I have access to the folks who are investing in, underlying manufacturing businesses or defense companies or AI and so we're, at the end of the day, real estate is just a derivative. Real estate demand is just a derivative of the underlying businesses who will be our tenants. And so being able to work with in a very direct way, the people who are directly investing in those companies, and frankly, being able to invest, to speak actively with, our currency investors, and just the whole host across the investable universe, I think gives us such a unique edge because, I mean, you obviously very know this very well. Real estate is super local, but at the end of the day, the long-term trends that drive capital flows and fundamentals are much more macro. And so having access and interaction to these great minds is a huge competitive advantage.
Let's zoom back into real estate. What does the MSREI business comprise today, and which are the biggest verticals and growth areas?
Yeah, so our real estate investing business, we manage, we have about $60 billion of gross real estate assets across the world. We have a team of north of 200 dedicated real estate investors, 17 offices, 12 countries. So we are very global and very, very local in the markets in which we invest. In terms of how we invest, we've made a very concerted effort to do a small number of things and endeavor to be category killers and top performers in each of those. So what do? We manage a series of core funds in each of the three regions. So here in the US, Europe, and Asia, at one end of the spectrum. At the other end of the spectrum, we manage a series of global value-add opportunistic funds. In between, we have a couple of core plus strategies. So we have a net lease strategy, for example, focused on mission critical net lease assets. So assets that are long-term leased to high credit tenants, and in a Japan only strategy. So that's sort of the range of what we do within real estate. And our investment professionals work across all of those strategies, which I think gives them enormous perspective. So again, we sort of have a very, very global remit and a big, broad team, mega cap scale, but we apply that to a small number of funds so that we can really drive performance in those vehicles.
You've made a lot of successful out of consensus calls. For example, as you talked about earlier, leaning into logistics ahead of the e-commerce wave. What drives that kind of conviction?
For us, conviction really comes from evidence and preparation. We are enormously analytical and research driven. But I would say, it's not, sometimes you can't just rely upon sort of the data because data can by nature be backwards looking. And I think one of the advantages we have is having better, more real-time data. Having such a large existing portfolio, having such broad tenant relationships, I think gives us indicia of change early. We are speaking to our tenants constantly to understand how they're using space. So in the industrial, the e-commerce industrial example you referenced, we were, of course, tracking all the data in terms of e-commerce driven leasing and e-commerce utilization and penetration rates, et cetera, et cetera. But what was almost more informative was to understand how our tenants were using space as they were confronting this fundamental shift in consumer behavior, the omni-channel marketing, what that meant in terms of the volume of space they needed, in terms of the types of space, in terms of where did they want to be. And frankly, having a global platform really helped inform us because while I think in general, many behavioral trends start here in the US and then sort of get exported overseas, I would say e-commerce is one where actually, Shanghai was ahead of New York in terms of e-commerce penetration. And so having that sort of global perspective, both again, in terms of the data, but also in terms of our team, and our team being so coordinated in our perspectives was a real help.
After the GFC, you recalibrated your exposure to office earlier than many. What sort of made you do that? And what's your view of the office sector today?
The fundamental observation that we had that really drove us to reduce our office exposure here in the US, in particular, was an acknowledgement of how capital intensive office is. And again, here is another place where I think having such a global platform really helped us get there sooner. I say that because we looked across our global office portfolio, and, we own office assets in many, many, many global jurisdictions. And, I so specifically remember comparing Tokyo to New York. And, at the time, this will be roughly correct, New York office cap rates were maybe like 5%. And, Tokyo office cap rates were maybe 3.5%, something like that. And, the conventional wisdom would have been that the delta was really to be accounted for in the relative rate environment between the two. And, when we study this, what we realized is, office there should be more differential in pricing, because in Japan, if you have a 3.5% cap rate, you take home 3.5%, because in Japan, the tenants are paying for their space build out. So you rent them space, they pay you. They build out their space. Whereas in the US, as you obviously know, you are constantly writing checks to get tenants and to keep them in their space. So you might have $100 rent, but you would have with that perhaps a $200 tenant improvement dollar. So, we tend to like assets where you are taking cash flow out, not putting it back in. And I think recognizing just the sort of true CapEx adjusted yields was really what made us say, not that office is a fundamentally bad asset class, but that it was just mispriced. And it worked for so long because it was such a big trading asset, right? It works to put $200 a foot into a building to buy up your rent if you're going to then sell it for a 20 times multiple. But that only works in that trading scheme. And so I think that was really the insight we had. And I would say that caused us to dramatically reduce our office exposure here in the US to only keep those office assets that were the highest quality. And by the way, those have continued to perform. But did not cause us to reduce our office exposure in markets like Tokyo that are just structured differently.
What are your views on the signals or lack thereof of public markets relative to private markets, and whether that's a signal for entering or exiting sectors?
Look, I think when you and I started in the business, there was probably a much higher correlation than there is today. And certainly, public markets led, private markets followed on the way up, on the way down. And not to say that's not true today, but for a whole host of technical reasons, among others, there's just a breakdown in that correlation, right? REITs, tend to trade more similar to financials, right? They're included in various market indices. There's much more passive investment. There's frankly, a secular decline in the dedicated REIT investors. I think when we started the business, people talked about like the REIT mafia, which was the, investors who were, REIT fund investors. And they generally made judgments based on where where companies were trading relative to net asset value. And I think the, premium or discount to NAV as a leading indicator of value has declined over time. So it is important. Don't get me wrong. It is particularly important to me in those sectors and markets that tend to be heavily predominated by REITs. So if I'm investing in a space where REITs are the biggest marginal buyer, you better believe I care where REIT prices are, because I want to know what their cost of capital is. But it's not necessarily as pure of an indication of the market. With that said, I would say, we feel pretty strongly we're at a real estate market bottom today. And I would tell you that the REIT market is indicating the same, right? REITs have had one of the best starts to the year, certainly over the last, 6-7 years as 26 has started. So on the one hand, I don't think it is as relevant as it used to be. On the other hand, there's, some relevance. And I think that it is telling us that we are, heading towards a rebounding real estate cycle.
As you mentioned earlier, how people live, work, age, and consume should drive investment strategy in real estate. So can you walk us through that framework and some of your high conviction themes today?
At the end of the day, yes, real estate is just a function of how we humans like to use space. And, I think that matters in terms of market preference. When you see these massive migratory shifts, you tend to want to be in those markets that people are wanting to go to, with the important caveat that I think supply still trumps. So why has the Sun Belt had a tough time, notwithstanding everybody seems to want to live there? It's because there are very few or fewer supply constraints. But in terms of just these shifts, I would say high conviction for us. One example would be senior housing. And this is fundamentally just a belief in the overwhelming demand driven by the silver tsunami. So when you look at the population growth in our country, you're seeing, 4.5% plus population growth in the 80 plus cohort, in the 80 plus year old cohort, while overall population is essentially flat. So it's where a lot of the population growth is. It's also importantly where so much of the wealth is concentrated, right? The boomers control over half of this country's wealth. It's what the wealthiest generation we've seen. And so when you have a lot of them with a lot of money, that translates into a lot of demand for senior housing. And you couple that with a real decline in supply, we think this is a bit of a golden era for senior housing in terms of the income growth potential. But I would say, the silver tsunami, so to speak, we could see it coming before COVID, right? The great thing about demographics is they're knowable, right? That's one of the things we love about these structural demand drivers is you're not guessing. You are making investment judgments around things you know. And we knew that cohort was getting older, right? We knew the population was aging pre-COVID. And because of that, we loved the idea of senior housing. I would tell you, we didn't invest a single dollar in the decade leading up to COVID in senior housing. Why is that? Because, frankly, others also saw the same demographic data. They knew people were getting older and they said, gosh, senior housing's going to be it. And what did that mean? That meant senior housing was too expensive. It was too oversupplied. And at the same time, it was also too early, right? People don't move into senior housing at 75. They move in on average at 82, 83. And so I think we exercised the discipline to not act throughout that period because we didn't feel like we were being properly compensated for it. But when COVID hit and the space really dislocated, when you saw occupancy plummet and wages spike, and then shortly thereafter, interest rates spike, that space really became undone. And that's when we stepped in, in a very big way. So that's an example, I think, of where we're investing around these durable megatrends, these demographic drivers, but still still factoring in the cyclical shifts, right? So that you can capitalize on both the structural, but optimize for the cyclical.
Any other big themes in the US, and what are your views on data centers from a real estate investor perspective?
Yeah. So another space that we continue to love in the US is industrial. And again, similarly driven by structural tailwinds. So, we talked about e-commerce growth. I would say that, we believe AI is an accelerant to e-commerce penetration, to e-commerce growth. So we think that will help continue to drive e-commerce sales, which has a direct tie into industrial demand. I'd say advanced manufacturing, which obviously also has an AI component, is also driving demand for industrial. The third, major driver we see of industrial is just, we think we're at the early innings of a rebuild of the global supply chain, right? And it's driven by what we know. It's just we are doing a U-turn on globalization. And we are seeing an increased frequency and severity of event-driven supply shocks. And both of those things, interrelated as they are, but in some ways also distinct, right? You think about these event-driven supply shocks. COVID was the first big one, right? Like people talk about the supply chain realignment as though it started on so-called Liberation Day, and that's just not true. I mean, COVID when, we couldn't get, our sneakers because they were stuck out in the port of LA or because factories were shut down in China. That was sort of the first event driven supply shock. But then, you had, tragically, Baltimore Bridge, you had, the Houthi rebels in the Red Sea, you had what's going on today in the Strait. You have all of these supply shocks that I think are causing companies, to learn the hard way, frankly, about putting all of their eggs in one basket. And that's causing them to diversify where they manufacture their goods and how they get those goods to the end consumer. So, right, they're not manufacturing everything in China anymore. And guess what? They're also not putting everything in the same trade route because they better have multiple ways to get it. And what that's doing is creating incremental demand for industrial and creating winners and losers within industrial. So that is a very high conviction strategy for us, but it's one where I think you need to be extraordinarily disciplined and specific in where you go. So just to, kind of underscore the point, you take industrial, it sounds like, one asset class. You take industrial in the state of California, and you would say maybe you think that's going to all behave similarly. Well, if you look at rents in industrial by Silicon Valley, tied to sort of the advanced manufacturing that's going on there, I think rents are up, well north of 30% over the last few years. Whereas if you drive 400 miles due south to the Inland Empire, which was the hottest industrial market on the planet, rents over the same period of time are down 40%. So it's a high conviction strategy for us, but one where you need to be very, very specific.
Any views on data centers?
We invest in data centers, particularly in our infrastructure business. And, I would say the demand side of data centers, at least the present demand side, is pretty self-evident. I think that is quite compelling. I think what perhaps is less clear is whether the long-term growth and obsolescence profile, sort of residual value, whether those factors ultimately justify some of the valuation levels that we're seeing today. There is understandably so much capital rushing into AI and so much, substantive enthusiasm, also so much hype. And so I think like all things that have that AI halo, in some instances, we think there's sort of a pricing halo that may or may not be justified. Obviously, it's very case specific. I would say what's maybe a more interesting observation is that, everyone talks of when people talk about infrastructure or real estate and the impact of AI, everyone immediately goes to data centers. And I think what's often overlooked is how AI is driving other types of infrastructure and real estate demand. So power would be the obvious one. And certainly our infrastructure team is, very invested in various types of energy and energy transition assets. But also even within real estate, we see it affect, we talked about some of the effects it's having on industrial. We even see it flowing through to impacts on our residential assets, right? We own some extraordinary residential assets and a residential company. And we see just the operational improvements from both a revenue and an expense side of AI.
Stepping outside of the US, where are you leaning into globally and why?
We invest across the world, or I should say, we invest across the US, Europe, and Asia. We are very active today in Japan. I would say, obviously today Japan is getting so much buzz and enthusiasm and capital flows. All of the sort of enthusiasm around corporate governance reforms and positive effects of healthy inflation. And oh my God, there's now rent growth in the market. And so all of this, I would tell you bluntly that while that is fantastic and a great tailwind, that is not why we are there. We have been investing in that market very actively for the last 30 years and over a period where that enthusiasm did not exist. We were investing over 3 decades when you had no growth, literally no growth, frankly, pretty challenging demographics, so aging population, shrinking population, and it's been one of our most successful markets globally throughout that period of time. And it's for a host of reasons, but I think it is really a market where being super local is an enormous competitive advantage. And we have the most extraordinary team that is super embedded in that market, who really understands the nuances, who has been working with the counterparties, who have been working with companies that are looking to dispose of their non-core real estate assets for decades. And that's a huge, huge competitive advantage. So, we've certainly seen in Japan and in our hotels there, a rise in inbound tourism. I'd say we've also seen a rise in inbound tourist investors. And we think that at some point that will be, interesting to see how it shakes out. But we love that market overall.
Real estate investors have been very active in the credit space the last few years. Where do you think we are in the cycle of, real estate credit versus equity?
I think there's really a role for both an investor's portfolio. So I don't sometimes, that question, or sometimes how that question is framed, is as though it is zero sum. And actually, I think they each play a pretty important role. On the one hand, I'd say today is an increasingly good time to be a borrower, right? We've seen real estate credit spreads compress, and that, obviously is great for us as borrowers. But I'd say it's also quite a good time to be a real estate lender. And some of that benefit of the spread compression flows through because many of these real estate lending businesses themselves take on leverage. They have some benefit from that. But I'd say, more importantly, fundamentally, we think, at a cyclical bottom for real estate. And so having the opportunity to invest in a space that has really strong structural tailwinds, so coupled with sort of a low entry point, is really attractive. And, on the real estate credit side, when I think about real estate credit versus corporate credit, it feels pretty clear that real estate credit, you're getting in at a basis advantage. If you're lending at 60% loan to cost, you're lending, your denominator, your cost is probably 20% plus below where it was. And so I think you really have that advantage.
You've already just sort of highlighted some of the great advantages, but real estate has been struggling to compete against other forms of capital, infrastructure, private equity, venture, public securities due to underperformance. And are there any other arguments or compelling points that you're making to global CIOs sort of to get back and increase their real estate allocations?
Yeah, look, I think there's the cyclical that we've been kind of talking about, and then there's the structural. In terms of the cyclical, again, real estate values down 20 to 25%, while the broader investable universe at near all-time highs, even post all the recent disruption in the markets. So I think the kind of vignette of relative pricing is there. But I'd say I also think there's a return to the acknowledgement of the role that real estate and, frankly, real assets play in investors' portfolios, right? It is among the best inflation hedging assets you can have across the broader investable universe. And I don't know about you, but I would say I think most investors are acknowledging today that inflation is a real risk. Regardless of your ultimate perspective, I think we can all agree that one of the things you want to be most careful about in your portfolio today is thinking about your inflation hedging. And real estate, again, and infrastructure are very effective inflation hedges, not only because the income tends to be directly or indirectly indexed to inflation, but also because when you have periods of elevated inflation, supply tends to fall off. And, that provides a pretty effective inflation hedge. And so, we think there is a broad sort of acknowledgement of that, or an increasing acknowledgement of that. I'd say, other benefits that real estate offers, I mean, it is the low correlation to other asset classes is I think, always important. And I would argue particularly important today in a market environment where we've seen the breakdown of traditional correlations, right? We've grown up with textbooks telling us that when equities behave this way, bonds behave this way, and ergo your portfolio composition should be this. And what have we seen? We've seen asset classes perform more in tandem than we would have expected. Well, guess what has not? Real estate has not. And so I think that that lower correlation to other asset classes is increasingly important. Um, and I think, again, that alignment with those structural mega trends. You look at some of the themes that are so paramount or front and center today, like this, multipolar world or aging demographics. And you see investors try to play those from an equity standpoint. And so guess what? You see, for example, defense stocks way up. Well, you can play defense or play, multipolar world through those companies, but you can also buy industrial assets in some of these innovation clusters where you're playing some of the same themes, but maybe doing so in a bit of a downside protected way.
There's been a dearth of core capital in the US, especially for larger deals. How and when do you expect that to change?
Well, I think we're seeing that change already. Certainly, if you zoom out from just core capital to capital writ large, I'd say we are seeing, more capital, more buyers, frankly, more sellers, more deals, right? Transaction volume is way up. And cost of capital coming down, right? You're seeing more debt, cheaper debt. And by the way, more types of debt, right? I mean, you're even seeing lending to office again, right? To US office again. And, when office financing is warming up, what does that tell you in terms of where the direction of travel is for the financing market? So, I think you're seeing real capital formation, debt, equity, et cetera. In terms of core capital, specifically, or let me say, in terms of sort of institutional capital, the other thing that is true today is that some of the pullback you saw in core capital and specifically in Odyssey funds, for example, was driven by the denominator effect, right? Institutions, as we know, tend to have target allocations to each asset class, including to real estate. And what happened over a period of time is that real estate had gone up and other asset classes hadn't, and institutions ended up over allocated to real estate. So they did what they are supposed to do, which is they tried to reduce their real estate exposure. And that drove, certainly not all, but a decent amount of the redemption activity that I think the industry saw. Well, today we have the opposite. Today, because real estate is way down and everything else, the numerator is way down and the denominator is way up, you're finding institutions wake up and realize they are under allocated to real estate. And in fact, we're seeing the responses to that. So you saw a dramatic pickup in institutional capital raising in real estate over the last 12 months. And it's, it's showing up in the numbers. It's certainly what we are hearing from our clients in terms of their desire to invest in the space. And so that's a very long-winded way of saying, I think it is coming right now.
Where are the largest pools of capital globally that are looking to invest in real estate? Where are those sort of pools of capital based? And then where in the world are they looking to invest in real estate if they are going to deploy?
When you and I started in the business, I think institutional real estate investing was largely the domain of U.S. pension funds, right? I think that was they were the original institutional investor base for real estate. And what we've seen over the last 25 plus years is a real broadening out and globalizing of the institutional investor base for real estate. And so the point being, it's everywhere. You're seeing it in the US, you're seeing it throughout Asia, you're seeing it in Europe. You're seeing it in the Middle East. So it's really global, and there are sort of idiosyncratic factors that, shift maybe year to year, or, few year increment to few year increment, but it is really a global landscape. Obviously, the newest entrant, so to speak, is individual investor capital, is the so-called democratization of real estate and other alternatives. And so retail capital is playing an increasing role in the real estate capital base. And obviously, individuals are substantially less allocated to private real estate, whether equity or credit or infrastructure for that matter, than institutions are. So you're seeing an increase in that as well.
So the biggest lessons you've internalized about managing through downturns and then being ready for inflection points, as you've described 2026 to be?
Forgive me if this sounds corny, but our CEO, Ted Pick, often talks about sort of the culture of Morgan Stanley as one of rigor, humility, and partnership. And I hate to take somebody else's words, but I think when I think about what has made our real estate business and our infrastructure and credit businesses successful over time, I think much of it is just that, right? It is the rigor to, again, make decisions based on, real, just a rigorous assessment of the facts at hand. To be clear, you are absolutely always going to make decisions amidst uncertainty, but to make the best judgments, to understand and to be as rigorous as possible. But the next word, humility, is such an important part of it, right? To be able to acknowledge mistakes early, right? To really be willing to acknowledge them and own them and pivot is so critical. And then partnership. Again, I think the thing I love the most about what I do is that I work with extraordinary partners, and we challenge each other, every day. I mean, we are extremely, we trust each other. We're so close, but we go at it, right? And we really, believe that the sum, that the whole is greater than the sum of the parts, and having that is an enormous value.
You have to balance managing a global platform, but empowering, local teams. And as Charlie Munger said, show me the incentive and I'll show you the outcome. Tell us about your experience recalibrating incentive structures across a global platform to improve performance.
The thing that I think is perhaps even the most powerful thing about our platform in terms of driving the best decisions is this combination of being super global, but super local, right? We have these extraordinary local teams that you reference. I mean, really like the best in the business. And they have every nuance of the market, right? Corner to corner. And they know every person, and they know every tenant that wants to be anywhere before they're there. And, like all of that data. But yet we have this global perspective that really enables us to understand over time where the puck is going. And that combination of having that really bottoms up perspective with that global macro, it is the essence of what drives best decisions. But as your question frames, that only works if you set it up in a way that you optimize both. And I would say one of the most important lessons learned for us, maybe as Munger's quote suggests, is you need to structure things to have consistent behavior. You need to set things up in that way. So just as a few examples, say we have globally centralized decision making. So we have these extraordinary local teams. But it's not like we have regional investment committees, right? Our investment committees are global. They are getting the full benefit of everything sort of we know that's going on around the world. Our incentive structures are totally pooled, right? So the carried interest across our global funds pre-GFC was more individual, right? So individuals were incentivized to, invest in their countries and their markets. today our carried interest is fully pooled. And so, we have our team, not just, myself and my most senior partners, but every single person on the team is incentivized to say, gosh, I might think this, whatever, residential asset um, in Miami is really interesting. But when I compare it to the residential asset I'm seeing in Sweden, or maybe it's the, industrial asset I see in Seoul, that's actually more interesting. And so there's that constant calibration of risk and opportunity that I think really helps us drive to the best, to sort of maximize the benefit of that wide funnel into picking and cherry picking the best opportunities. And again, as your question suggests, I think we're able to do that because people have exceptional judgment, but we're also able to do that because people are really incentivized that they only perform well if the whole performs well. And so they have no incentive to push an investment or advocate for an investment where if there is a better opportunity somewhere else in the world.
What advice would you have for young investors who want to build a long-term career in real estate?
Most important to me is to always surround yourself with the smartest people you can find, right? To work for the smartest people and to work with the smartest people. And it's sort of, you never, ever, 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 ever want to be the smartest person in the room, right? You always want to be surrounded by the greatest minds. And I think that is what helps you grow, whether as a real estate investor or in anything you could possibly do. So I think that's paramount. I think, a piece of advice that maybe it seems to be a little overlooked these days is to just really invest in relationships and in particular with your peers. So you see a lot of people in our industry totally understandably, networking and focus on finding the right mentors and, knowing the, folks who run the businesses. And obviously that is important. And mentorship is so critical to our business and to every business. With that said, at the end of the day, I think sometimes they overlook the importance of developing those trusted relationships with their peers. And I think, you and I have known each other a long time. I think about the most important business relationships in my life, and they're the people I've grown up with over the last 25 years. It's those relationships that I formed when I was, 22 and didn't know a darn thing. And I think that is something that I would encourage people to really spend time on.
What are your future objectives for the real assets business? Where do you want to see it in the next 5 to 10 years?
Look, we are a very performance-oriented culture. And so, first and foremost, my objective is for us to deliver the best performance, the best risk-adjusted performance across everything we do to our investors. We serve a really important role for our clients who are doing incredible things, and whether they're pension funds or otherwise. So we take very seriously that responsibility. So that's first and foremost. And I think as part of that, beyond sort of the performance of the funds that we manage, thinking about what more we can do, for our clients over time. So whether that's, additional strategies or structures, that's certainly something that is important to us as well.
Lauren, before we wrap up, I'd love to ask you what you do outside of real estate.
I love what I do in the office, and I love what I do out of the office. And most of what I do out of the office is with my children. I'm, really blessed. I have a son and a daughter, and I spend most of my free time with them, and I would say most of that time outside. So I think just having that, freedom of, that sort of ability to experience the outdoors, whether it's, hikes or pickleball or any, biking, any activity, for me at least, is like an incredible antidote to what we do. And, I know some people meditate, and maybe one day I'll be evolved enough to meditate. But for me, it's sort of just meditative to be on long walks or playing cards with my kids. And I know that's what I love.
That's, incredibly important. And thank you for sharing that with us. And thank you so much for joining us on the Real Estate Forum podcast. We look forward to seeing how you continue to lead and scale the global real assets platform at Morgan Stanley and your continued leadership across the real estate business. So thank you, Lauren.
Thank you so much for having me.
Thank you for listening to the Real Estate Forum, a podcast brought to you by the Paul Milstein Center for Real Estate at Columbia Business School. Be sure to subscribe for more insights from real estate thought leaders, industry professionals, faculty, and the latest research and expertise from the Milstein Center's Research Lab at Columbia Business School. If you've enjoyed the episode, please follow, rate, and share the podcast. You can keep up to date with the Paul Milstein Center for Real Estate at business.columbia.edu/real estate. Thanks again for joining us, and we will see you next time.